Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Good morning, everybody. It's just a couple minutes before 10, so I'm going to let everybody file in. We have a full agenda this morning. Hopefully, I'll be able to keep it within half an hour, 45 minutes. But I hope everybody's doing great today. It's a beautiful Tuesday, as all these Tuesdays seem to be. So we've had a great run of it. A little bit of a challenging weekend weather-wise, but I hope everybody had a great Mother's Day. We spent our Mother's Day at a dance competition for my 14-year-old daughter, so that was actually a really nice time. Everybody enjoyed it. So they're a lot more pleasant than they used to be. They used to be, if any of you have ever been at dance competitions, they started about 7 o'clock in the morning and go till about 11 o'clock at night. And some of the new COVID restrictions require it to be more divided. So we started at 7:30 and we were done by 10:30, and it was just 2 dance schools. So it was kind of glorious. So that's one thing that I hope continues from COVID. And, there are positives, and I've talked about those in the past. There's certainly positives that have come out of this. And that's, things like that for comfort, but things like being able to work remotely. I shared with you that we have a new employee that started, just about 90 days ago now, who's based in Florida. And we have another employee who just spent 2 weeks working in Florida and didn't skip a beat. So I work from home most of the time, and it works really well. And here I am sitting at my home office again today. So let's go ahead and get started. It is May 11th. Challenging time in the markets for sure. I'm looking over at the screen. The markets are down. The S&P 500 is down so far this morning, and we expect a lot more of that today. And so, just as a reminder, what I do on these webinars, if it's it looks like we have some first-time people maybe joining us. We spend the first portion going through a market update, and I read through some analyst reports that I get throughout the week, and I share with you some of the highlights of those and what I think are applicable and important. And then we have a planning discussion. So I like to divide it up into 2 different things, the investment side and the planning side, both of them equally important. So I just want to remind you all that this webinar, you are muted. There is a Q&A at the bottom of the screen there, so you can click in and ask questions. Chat is disabled, and these webinars are always recorded, and the recordings are coming along nicely. So we're through 2021, I believe, and 2020 is being worked on and probably just about done. So they should start getting loaded up to the website, hopefully very soon. But it is quite a process, so I appreciate your patience. And they'll be, you'll have access to them on the website, but you'll have to enter in your email, and you can find webinars that are interesting to you. So we have some upcoming special webinars. So the special webinars are typically at 6:30 on Wednesdays. A lot of people can't do these 10 a.m. on Tuesdays. So we do 6:30 on Wednesdays once a month. And we have 4 now. I added another one, but we have funding, using annuities, and retirement planning and wealth conversions. The second being fiduciary assistance for powers of attorney, trustees, and executors. The third being investment fundamentals. And the fourth being the reality of the 4% rule. So, honestly, in June, I may have to do, or I may want to do 2. That month. We're having some scheduling conflicts. That's why you haven't gotten the invitation yet, but I'm hoping that gets done this week. We have some people on pent up vacation starting in June and July. So I'm having some trouble with that, but that's all positive, right? Because my staff, including myself, couldn't take really any vacations last year, and I let them carry them forward to this year. So, they've all been working very hard. So we want to make sure they get some downtime as well. Today on the planning side, we're going to talk about tax efficient planning with a traditional IRA. Last week, we talked about Roth IRA fundamentals. Today, we're going to talk about traditional IRAs. So not enough time gets spent on this topic. There are ways to make your traditional IRA potentially tax efficient. So we're going to talk about that as well today. So a lot to talk about in the Ed slot updates. I thought there were two really good pieces that came out today, or over the past week, excuse me. So both of these are from Sarah Brenner. So Ed doesn't do this alone. Ed has a great team of individuals. Sarah is really kind of my go-to person that I contact. Her and Andy Ives, but I spend most of my time with Sarah. So these experts that Ed employs are really great at what they do as far as having the information for us and helping us research topics to do a better job for you. Anything that has to do with IRA distribution planning, tax laws, things like that. So Sarah happens to be an attorney, and she writes quite a bit now for Ed and his group. So this question came in, and the writer wrote, I am 83 years old with an IRA rollover account, regular IRA account, and a small Roth IRA. If I convert a portion of either rollover or regular IRA to a Roth IRA and die before 5 years after the conversion, is there any penalty to me or the beneficiaries? So good question. This 5-year rule really confounds people. So I'll tell you, we can make it very, very difficult, or we can make it really simple. It is difficult if you're prior to 59 and a half. There are different schedules for each conversion, each contribution. But once you reach over 59 and a half, as long as you've had an IRA account, any IRA account with any balance in it for more than 5 years, you are past that 5-year rule. That's why you don't want to mess around. Get a Roth IRA established, get the clock rolling, and then you don't have to worry about it anymore. 5 years, as we know, passes like that. But this is a good question. So he has 3 accounts: an IRA rollover account, a regular IRA account, and a small Roth IRA. So is there any penalty to me or my beneficiaries if he dies before 5 years after any conversion he does? So can he convert? We all know he can. Rollover account and a regular IRA account. And then he says, also, can I convert to the existing Roth IRA, or should I start a new Roth IRA? I do not plan to make any withdrawals from any Roth IRA. Doesn't make a difference from which IRA I convert funds. This fellow's name is George. So his question is, I've got these 3 accounts, to a rollover IRA, a traditional IRA, and a Roth IRA. Can he convert? And which one makes sense first? And if he passes, so he says he's not going to withdraw anything out of them, and so he's going to leave them all to his heirs. But if he passes over the 5 years, or during that 5 years, what happens? So good question. So let's see what Sarah says. Sarah says, I can hear Sarah saying this when I read her words. Sarah says, you can convert either the regular IRA or the IRA that was funded by a rollover. From a tax perspective, it will make no difference. There's no difference from we have these titlings: rollover IRA, traditional IRA. The IRS sees no difference in those two. People sometimes get hung up on that, but there is no difference between the two from a tax reporting perspective. From a tax perspective, it will make no difference. Unless you have some after-tax dollars in either IRA, the conversion will be fully taxable. So if there are some after-tax dollars, if there's been contributions made and those funds were already taxed, either in a after-tax contributions in a 401k that were rolled over to a Roth IRA, or a regular IRA or traditional IRA, or you made non-deductible IRA contributions, you would have after-tax dollars. And you don't want, if you convert those, you want to make sure that you're getting credit for those, so you don't pay tax on them again. Starting a new Roth IRA would have no tax benefit. Makes sense. When it comes to distribution to your beneficiaries, there would be no 10% penalty, regardless of whether a 5-year period has been satisfied. That is because the 10% early distribution penalty never applies to distribution from inherited IRAs. Right? You can take as much as you'd like out of an inherited IRA. There's an amount that you must take. Well, not anymore. You must take the full amount by the end of 10 years. And we got some clarification on that IRS memo, by the way. That is because the 10% early distribution penalty never applies to distributions from inherited IRAs. The only issue would be that your beneficiaries would have to wait out your 5-year period to receive a qualified tax-free distribution of earnings. So anything that's converted if you convert $1 million and you pass that $1 million, let's say if you convert $1 million and it grows to 1.5 and it hasn't yet been the 5 years, the $1 million is always free for distribution. The $500,000 has to wait until the end of that 5-year period because it's just the earnings. Whether it's conversions or contributions, those can come back to you first or out to your heirs first without any kind of tax. It's the earnings that are subject to the 5-year rule. That's why you want to get those Roth IRAs started as soon as possible. If you're not sure if you're going to be doing Roth conversions this year, open up a Roth IRA anyway if you're able to, and put $1,000 in it and get that started. Okay, so question: if I have a client, here's another question. So if I have a client, husband and wife, filing jointly with earned income, can they continue to contribute to a traditional IRA beyond age 73? So this is interesting. I see these come in from financial advisors and financial planners and CPAs, and I think to myself, so these folks just find Ed Slott. They know that the Wall Street Journal calls him the country's best IRA expert. I think they refer to him as. But if you're going to ask these questions of Ed Slott, why not just join his group? So yes, it's a time commitment, it's a financial commitment, but boy, the benefits are just outrageous. And I'm still, you've heard me say it a million times, I'm amazed that there's only 400 of us in the entire country that are part of his group because it's so beneficial. So if I have a client, husband and wife filing jointly with earned income, can they continue to contribute to a traditional IRA beyond age 73? So do you remember before the Secure Act, whether you worked or not, you couldn't contribute, and whether you were able, per the IRS guidelines, to contribute to an IRA, there was a cutoff at age 72. Once you, it was 72 and a half, 72 RMDs. Once you reached that age, you could not contribute to IRAs anymore. But the Secure Act changed that. So Sarah writes, the Secure Act brought good news for older individuals with earned income looking to contribute to traditional IRA. Starting for 2020 contributions, the rule prohibiting contributions once an individual reaches age 70 and a half no longer exists. That was the old required beginning date. And it used to be that you couldn't make any contributions, even if you were otherwise allowed to, after you reach that age. A little bit of ageism for contributions. If your clients have earned income, now they can go ahead and make traditional IRA contributions regardless of their ages because of the Secure Act. So that's another great question. Now, speaking of the Secure Act, there is discussion in the House, and as recently as May 5th, the House Ways and Means Committee unanimously passed the Securing a Strong Retirement Act of 2021. So the Secure Act of 2020, I think that occurred early 2020, maybe late 2019. But the Secure Act of 2020 was the Securing a Strong Retirement Act. So now there's a Securing a Strong Retirement Act of 2021, and it's designed, per the lawmakers, to pick up the Secure Act of 2019. That's right, it was 2019, and they're calling it the son of Secure. So they make big changes to retirement accounts, and here are some of the highlights. Rothification. Rothification is back. So if you remember during the Tax Cuts and Jobs Act, there was a big discussion around a Rothification of 401k plans. So Congress wanted to limit the amount that you could put into a traditional IRA, and they wanted the remainder to be pushed over to Roth 401ks. You know, I get asked the question all the time, well, geez, Mark, you're recommending these Roth conversions. What happens if they suddenly say Roth IRAs are no good? Well, Congress doesn't think that way. We're long-term planners. We want your money to last the remainder of your life, and if possible, into the next generation. Congress wants your money now. They don't think like that. Remember, most of them have a 2-year window, and that's all they're focused on, in my opinion. So what's written here is the trend towards more Roth accounts continues as Congress is proposing allowing both simple and SEP Roth IRAs. Now it can't do that. But they're talking about adding that on. In addition, planned catch-up contributions would be required to be made to Roth plan accounts, and plans could allow participants to have employer matching contributions made as Roth contributions. Now, also, that doesn't happen now. If your employer matches your contributions in your 401k, it has to go into the traditional side. They want to push that over to the Roth as well. Congress likes Roth IRAs and 401ks because they bring in immediate revenue since they are funded with after-tax dollars. They're hungry and down there in Washington. We're going to talk about some of the measures that they're still pushing today. They want our tax dollars as soon as possible. So some of the other highlighted changes: increasing the required first-year required minimum distribution. That's that RMD. Over time, from ages 72 to ages 75, that's a bonus for most of us. Indexing with the $1,000 IRA catch-up contributions for inflation. So right now, that $1,000 just stands if you're over age 50, and now they're going to increase that. They're talking about increasing it for inflation. Increasing the limit on catch-up contributions to 401ks and other plans for individuals who have attained age 62, 63, or 64. So once you hit those ages, you can contribute more. Eliminating the requirement that premiums for QLACs be limited to 25% of an individual's account balance. So what is a QLAC? A QLAC is a qualified longevity annuity contract. So we don't use those much. So a QLAC allows somebody to defer a portion of their funds in an IRA until age 85 at this point for required minimum distributions. You have to put it into a specific type of account status, and then that's delayed until age 85. And the other big one is reducing the penalty for failure to take RMDs from 50%, which that it currently is. So if you fail to take a required minimum distribution, you have to pay a penalty of 50% to 25%. That one surprises me because I'd be interested to see how many people actually pay that 50%, because it's pretty easily forgiven. Another big one is indexing the $100,000 QCD, qualified charitable distribution limit, for inflation, and allowing a once in a lifetime QCD to be split interest entities such as charitable remainder or unit trust. So that's an interesting one to see how far that goes. So stay tuned for that. Let me pause there and see if we have any questions. That was a lot of information. Okay, I see no questions. All right, so now I'm going to bring you up to speed on what's going on in the markets. So these numbers I'm going to share with you are as of last week. I need to make this a little larger so I can see. Last week, the Dow Jones Industrial Average, which is the largest average that most people follow when we're talking about the market, that and the S&P 500. Well, the Dow Jones Industrial Average was up 2.72%. It's down about 350 points today, but last week it was down 2.72%, or excuse me, up 2.72%. So far, year to date, 14.33, and 1 year. So from what was that, May 7th last year to May 7th this year, up 48%. The S&P 500 was up last week, 1.26%. The year to date is 13.24. Year over year, it's just about 50%, 49.33. The NASDAQ, however, was down 1.48, up 6.95% for the year, and over the year, 54%. So across the board, most of the indices other than the NASDAQ are up. The bonds, interest rates did go up slightly week over week. So fell slightly. I'm thinking about bond values. So interest rates fell slightly from 1.63 to 1.58 week over week, and that's for the 10-year Treasury. So that's as I've told you before, that is the market to watch. It's the bond market right now. So we've got quite a few issues from MFS, really some good information. So I'll read through that for you. The one has to do with the Biden White House proposals. So the Biden White House announced last week its third stimulus proposal since taking office in January. The American Families Plan is a $1.8 trillion proposal released on 4/28 that directs money to child care, paid family leave, and other domestic priorities. Previously, the American Rescue Plan scored at $1.9 trillion, and that was signed into law in March, if you remember. And the American Jobs Plan, $2.3 trillion infrastructure proposal released on 3/21 was introduced by the administration. So the hits keep coming with the money that's being proposed to come out of Washington. And this, if we were concerned about higher taxes a year ago, we ought to be I want to say panicked, but very concerned about it now, because before these initiatives, it was a bleak picture of how we were going to fund our deficits in this country. And it has to be done a combination in many ways, but certainly increased taxes. Boy, now I just don't know how we avoid going to doubling of taxes for the average middle class American within 10 years. With everything that's being spent out of Washington between the COVID relief and these other programs. There is the expanded child tax credit starts in July. So 90% of the estimated 50 million households in the United States that have children under the age of 18 are going to qualify for this. That's based on your adjusted gross income. So 90% of the people with children 18 and below are going to qualify for the expanded child tax credit per the American Rescue Plan that I talked about earlier. So this starts in July. The child tax credit will pay $300 per month per child, $300 per month per child. Boy, I'm the youngest of 13. Could you imagine? My parents would have received, that's a bucket full of money per child between the age, per child under the age of 6, and $250 per month per child between age 6 and 17. Additional amounts may be available for full-time college students under the age of 18. So that's a big one. The top, 2 weeks ago, we talked about capital gains, or maybe 3 weeks ago. The top capital gains rate in 2021 for a married filing joint taxpayer with taxable income of at least $496,000 is 23.8%. Remember, it goes up to the 20% rate, and then you have the 3.8% surcharge tax that came about due to the Affordable Care Act. On Thursday of 4/22/21, reports came out of the White House that favor an increase of the total top capital gains rate in 2022 for a married filing joint taxpayer with taxable income of at least $1 million to 43.4%. The highest capital gains rate in U.S. history is 39.875%. So that was in 1978. So this would be the highest capital gains rate we've ever had if it goes through. Now, it seems like what I'm reading is that amount won't go through, but if the amount is lessened, the dollar amount is also likely to be lessened, in my opinion. So you might end up with a $500,000 number, $496,600 like it is today, but maybe we go up back to that 39.6 area. So ready for vacation. The average daily cost of a short-term vacation rental for 3 to 7 days for the summer of 2021 is 26% higher. So what I didn't mention in my previous, or maybe I didn't get there yet, was many of these analysts are still, and you're seeing it now. We were talking about it in the summer of last year, the risk of higher inflation. Boy, are we seeing it in the building materials. I had somebody over last week to do some electrical work, and he said his costs of wire have either tripled or quadrupled. I don't remember, but he's buying it. Like, he won't do my job for probably 6 weeks, but he's buying the material today because he's worried about the inflation and it increasing another, third by then. So we're seeing massive inflation in certain areas. So it's 26% higher for vacation rentals from last year to this year. And that, of course, is just supply and demand. People want to get out, right? And they have the money to do it. And this is what I'm talking about wood. The average cost of building a new single family home in the U.S. has increased by 8% in the last year, solely because of the rising cost of lumber. Lumber mills shut down nationwide in 2020 for as long as 4 months, leading to a lumber shortage as home building demand accelerated. So have the people and we're seeing that in many areas. People can't come to work or aren't willing to come to work. And we had an overwhelming demand in the materials. People wanted to get work done to their homes and whatnot. So lumber imports into the U.S. have been impacted by a beetle plague ravaging Canadian forests in addition to that. So, I hope this isn't true, but when I was talking to my electrician about this last week, he said his supplier doesn't think that this is going to stop until 2025. So if we have 4 more years of this, this type of inflation, I don't know what people are going to do as far as working on their homes or buying homes. And speaking of demand for existing homes, the median price of a new single-family home built in the U.S. in March 2019 was 17% more expensive than the median price of an existing single home sold last year. The median price, or sold, excuse me, in 2019. That doesn't read right. So it should be March of 2021 was more expensive, 17% more expensive than the median price of an existing single home sold in March of 2019. So from 2 years ago, the median price of existing homes is up 17%. And new single homes built in the U.S. in March 21 was just 1% more expensive than the median price of an existing family home sold in March 2021. And how about this? Existing homes that were sold nationwide in March 2021 were on the market an average of 18 days. That is amazing. We're going to talk about standard deduction when we get into our planning phase, but the Tax Cuts and Jobs Act increased the standard deduction for taxpayers effective the 2018 tax year. As a result of the change, the percentage of households taking the standard deduction has increased from 70% to 90%. So 90% of the households that file tax returns are now taking the standard deduction. We see that all the time. So itemized or out the window. Remember, we talk about someone just asked me, does it make sense to keep interest on my mortgage? And I said, well, do you itemize your deductions? And they said, no. And well, certainly it doesn't make sense, because you're still going to get that full standard deduction. But even if you itemize your deductions, it probably doesn't make sense for you to pay interest just to get a deduction on it. That argument has never made sense to me. And if you have a question about that, contact me offline. Oh, and I didn't mention this. When we end our webinar today, as always, you're going to see my calendar populate. And that means you're going to have an opportunity to schedule an appointment with me. Now, if you're a client and you need to see me, schedule away. If we already have something on the books, like a financial planning appointment, especially, and you're scheduled for a week or two out, let's keep that appointment as it is, because we're doing a lot of work in the background to make sure that we're ready for that. If you're not a client yet and you want to schedule a consultation with me, a 50-minute consultation, you could do that if you haven't done that already. So if you've done that already and you want to talk to me again, just send me an email and we'll work something out. How about people going back to work? So as of March 2020, 4.2 million American workers have stepped away from the workforce because they're afraid of catching COVID-19 virus at work. So hopefully they start coming back in. Hopefully, we're easing these concerns 2 months later, and businesses can start operating again. Just 1 in 25 U.S. corporations surveyed anticipate requiring its employees to be vaccinated for the COVID-19 virus. So very, very few employers are requiring that vaccination. So we'll see how that works with coming back. So I told you about BlackRock. They're talking about, again, concern about volatility based on inflation, and as people return to the marketplace and start traveling. As I said, we're seeing it all over. Riverfront reads, they believe there are positive fundamentals in place that can lead to higher stock prices a year from now. They're encouraged by a rebound in corporate earnings, the healthy consumer, a robust housing market, improving employment, and a patient Federal Reserve. So that makes sense. They go on to say they are concerned by signs of inflation, COVID-19 trends, global tensions, and above average valuations. Okay. And that's it for the markets. We're going to jump into planning. Let's move to policy. If there's any questions, no questions. All right. So let's talk about that for the planning portion. As I said, we're going to talk about using traditional IRAs and if they can be tax efficient for you. So I'm going to go to my whiteboard. I'm going to share my screen with you. Okay. So raise your hand if you see my whiteboard in front of you, and you should see the tax planning table, 2021 tax planning table, and the uniform lifetime table. Okay, very good. Thank you. So we've seen both of these before, and I'll show you again where you can now download these directly. So I'm going to drag down here our website. So raise your hand for me again if you see the Attleboro Wealth Management website. All right, thank you. So if you're here and you go to Slot Corner, and again, you see a picture of me and Ed, you see some videos there, and you scroll down, and I put these here because these are Ed Slot's, you can see here, copyright by Ed Slot. And I use these all the time. I know I'm repeating myself, but I just want to share with you how valuable these are. So I use these all the time, and you can just go here and just look at them if you like. This is the Medicare income planning chart. This is the retirement plan contributions chart. This is again the 2021 tax planning chart, and then this is the health savings account chart. And this is the RMD chart. Now, this one that's shown here is for inherited IRAs, but on the other side of that is the one that I'm going to be using today. And you can just click in here, download now. You put in your email, and you can have any of these. So let me go to, let me just see something here. Yeah. Let me go back to my whiteboard, and I'm going to be using this 2021 tax planning chart, and I'm going to be using the RMD chart. So we should have this whiteboard back. And we want to talk here about standard deductions. So we just had a conversation about this. I'm going to highlight this. So here are our standard deductions. This is important. And don't forget about this portion. Hopefully your CPA, and hopefully you are working with a CPA, but hopefully your CPA doesn't forget this either. But really, if you're using tax planning software, tax prep software, it's going to capture it. But I always recommend, especially if you're embarking on a tax efficient Roth conversion or funding life insurance strategy, that you use a qualified accountant, and I believe that person should be a CPA. But we're going to focus on this area here, and I'm just going to make this a little larger. I know it's the green pen. That's what I want. All right. All right, so this area here, and then we're going to focus on RMDs up here. So let's go to our buckets. So you remember we have our taxable bucket. We have our tax deferred bucket. And then we have our tax advantaged or tax free bucket. So in here, this taxable bucket over here lives your stocks, bonds, mutual funds, ETFs, cash, CDs, anything that you pay regular tax on. So you get a 1099 every year, and you pay tax on dividends, interest, short-term gains, long-term gains, etc. And this is readily available, right? And how much should you have in here? You should have 6 months to 1 year worth of expenses. In your tax deferred bucket, well, this is your IRAs, traditional 401ks, SEP IRAs, simple IRAs, inherited IRAs, anything. This is deferred, anything that you haven't paid tax on yet. So you put money in maybe while you were working in your company 401k plan, or in one of these plans that you set up yourself, or an individual retirement account, an IRA, and you either got a tax deduction or you didn't, or it's a payroll deferral. You don't pay tax along the way. And the deal is you have to pay tax later when you draw it out. And then, of course, we have tax advantage, and this is Roth, anything Roth, and properly structured cash value life insurance, or some people like my friend David McKnight like to call them LERPs. And they're really the only two things that are truly tax-free or tax advantaged under the tax code, and HSAs. So we know we want to have 6 months to 1 year in this bucket, and there is a certain amount that we want to keep, a mathematical amount we want to keep in this bucket potentially, and then everything else we want to push over to this tax advantage bucket, because you remember there's no required minimum distributions and zero tax to you or your heirs. So you take out as much or as little as you'd like, and when you withdraw these, as long as you meet the guidelines, like I talked about, the 5-year rule, you pay 0% tax. But what about this tax deferred, right? These are, again, I told you, what about these IRAs? So I like to tell a story of one of my favorite clients. He came to us several years ago now after a class, and he said, Mark, I get this. I understand about converting to Roth. And I was talking to my life insurance agent, and he said, yes, you should convert everything into a Roth IRA. And I said, well, that's a great idea. I'm glad he's getting on the train there. How much did he say that you should do? And he said I should do all of it, get it done. Well, we looked at it and he had $3 million in this bucket. Now, if he converted that, all in 1 year, $3 million, what would that tax bill be? Well, we like to use a technical term called enormous, right? It would be enormous, big, huge tax bill, huge. And you really don't have to do that because, like I said, he came to us several years ago. So we were able to devise a plan that crossed over his conversions over X number of years. I think for him, it was 7 years, maybe longer. But what we determined for him is that he's able to leave about $350,000 in his IRA, never convert it, and he'll pay no tax on that. So how's that possible? And wouldn't it have been a shame if he would have listened to that life insurance agent, converted the whole thing, paid that big, huge, enormous tax bill all in 1 year, and including this $300,000 to $350,000 that he never had to pay tax on? Well, how could that be? Because absent any other income, if you don't have pensions, if you don't have rental properties, if you don't have anything else coming in that's messing this up, you can leave an amount in here that at the time of your required minimum distribution, which is currently age 72, so let's take age 72, is below your standard deduction. Well, what does that mean? This confuses a lot of people, so I'm going to spend some time on it. So we talked about the charts. So here we know the balance. Let's pick a balance. We're going to say $350,000. And for this example, I hope the math works out for us. But at age 72, this number here is what we're working on. At age 72, we take the year-end balance. So I'm just going to draw on it here. So the year-end balance of all IRAs, 401ks, anything that's in tax deferred, that's subject to required minimum distribution. Remember, IRAs can be aggregated, 401ks and retirement plans, pension plans cannot be. So we got to take all of it and we have to apply this factor. So what we do is at age 72, in his case, we said $350,000. That was, let's just say that was a year-end balance of 2020. And we divide that. Now let's see if this is going to work. If not, I may have to adjust that amount. Divided by 25.6. Yeah, so that's going to work. So we took $350,000 and we divide it by 25.6 and we get 13,671.87. So let's just call it 13,672. So that's what the IRS says. We take the balance at the end of the year, prior to the year you turn this age here, and you divide it, right? This is a factor. It's not a percentage. Now it'll get you somewhere in the first year around 3%, but people often ask, what's the percentage of what I have to take? It's not a percentage, it's a factor. And you'll see that it declines every year, right? So and this often happens, if we take $13,000 out of that $350,000 and then it grows, well, we could end up still at $350,000 here at age 75, couldn't we? The answer is yes. So we take $350,000 in age 75 and we divide that by 22.9. Now that is 15,284. I'm rounding up a little bit there. So is 15,284 greater than 13,672? The answer is yes. Your RMDs are on a curve. They go like this. It starts at 13,000 and it goes up to, X percentage, but it's going to be much greater. IRS wants your money, just like they want the Rothification of IRAs and 401ks. Now they want your money and they demand your money. And currently, if you don't do the R&D, you're subject to a 50% penalty of what you should have paid. That's a big one. So let's get back to this number. So this first year is 13,672. So let's go back down here. Now we know we kept $350,000 in this IRA. And at age 72, they have to take 13,672. Is that what we said? 13,672. They have, in that first year, they have to take required minimum distribution, 13,672. So that's the magic number there. So what is their standard deduction? It could be more if they're itemizing, but let's go back here to their standard deduction. Married couple, $25,100. That's their standard deduction. Standard deduction. But wait a minute, it doesn't stop there, right? Married couple, because we have this second section here. If they are married, if they're both over 65 years old, they each get another $1,350. There's a little bit more if you're blind, but let's just say that they're not 12,500 plus 1350 plus 1350. That's I did something wrong there. 25,100 plus 1350. $27,800. So that's their standard deduction, $27,800. $27,800. If they have no other income or no other income that exceeds the difference in that amount, would then their required minimum distribution be tax-free? The answer is yes, because they can take $13,672 out, and they have $27,800 worth of deduction. So that leaves them $13,672 with $14,128. Now, this can also apply to Social Security, and it can act really, really well for Social Security, because remember, you have provisional income tax. So provisional income tax is the tax that, that the IRS tracks to determine how much of your Social Security is taxed. So this helps with that, right? Because it's built on really required minimum distributions as well. So if you can manage to keep the difference, maybe if maybe 50% or 0% of your Social Security is subject to tax, ideally zero, then you still have a significant amount of money that's available for a standard deduction. And therefore, you might be able to even increase this. So I hope that makes sense. So there is a magic number that you could have, it's not magic, it's a mathematically ideal number that you can have in your IRA that can be tax-free because of your standard deduction. People forget about this and they think about, I have to transfer that entire amount. Now, it doesn't work if you have a pension, right? If your pension's small enough and it's less than $14,000, or your other income is less than $14,000, you may have some room. But I see pensions of $40,000, to $180,000 sometimes. If that's your pension, you're done for. You've got to transfer the entire thing via Roth conversion, and that's okay. If you have rental income, that's another big one. People have really big amounts of rental income coming in. That also will disqualify. If you have significant dividend, interest, capital gains, that's not going to help either, right? Because it's going to affect those standard deductions. So dividends and interest, particularly, that's going to affect those standard deductions. That's why when people come to me and they've got $1 million to $2 million sitting here, that's why we look at those life insurance retirement plans, because once that money gets into a properly structured life insurance retirement plan, then any funds that you draw out of there also aren't subject to tax as long as it's done correctly. And that can help this equation as well. So you'll see how it all layers together. And I don't want to get too far afield with it, but I don't want you to forget this. We talk about the tax advantage nature of life insurance retirement plans. We talk about the tax advantage nature of Roth IRAs. But if you're careful and it works for you, if you don't have pensions, if you don't have rental income, if you don't have too much dividends and interest, certain types of capital gains, then you may be able to keep a portion in your traditional IRA. Okay. It is, I don't see any questions. It is just about 10:45. Somehow, with all that information, we kept it right on schedule. So I hope that helps. I know you've heard this before. You've probably read it before, but repetition is really good. These are really complex strategies that we go through. Even clients have been working with me for many years. They say, oh, yeah, I forgot about that. And many people, we have a conversation. We'll have an hour-long financial planning meeting, an hour and a half long financial planning meeting. And I know often you walk away a day later and you say, what the heck did Mark say about that? So these conversations, I think, are really, really good to remind you. So maybe when we come back and I say, well, hey, and you'll say, well, wait a minute, why is that $300,000 staying in my traditional IRA? Well, because we could have a strategy like this where we can draw that money tax-free. And wouldn't it be a shame, like I said, if we transferred that money, converted it to a Roth IRA, and it didn't have to be. Now, you have to also be mindful of the single tax issue because, just like when one of you passes, the big change from married filing jointly to single, and, it's likely that one of you is going to be very suddenly single during your retirement, and your tax rates are going to double just by virtue of that. But that happens also with your standard deduction. So you go from 12,500 or 25,100 to 12,500, and then you pick up a little tiny bit more if you're over age 65 than you would be as an individual and a married couple. But your standard deduction is also cut in half. So you got to consider that. I do have some people that I'll recommend reducing that IRA to a sustainable amount for a single person. And that could be people with one of them has a health issue, or, we have people who don't come to us until they're well into their 70s. Most of our clients are coming to us in their late 50s, early 60s, mid 60s. I would say that's a normal span, but we certainly have people come to us in their mid 70s who are trying to catch up on getting this work done. And that's okay. It's a lot more. Well, it's the same amount of work. We just have to be more aggressive in it at times, but we can typically get it done. Okay, so I'm going to stop talking for today. We're going to see you next Tuesday at 10 o'clock again. And if you need to schedule some time with me, it looks like I have 4 days, just 4 days left in May. So that's tomorrow, Thursday, the 25th and the 26th. Available sometimes. And if you need to schedule time, please do so. And otherwise, I'll see you next Tuesday at 10 o'clock. Enjoy the rest of your week. I hope this was helpful. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.